Welcome back. Lots and lots of news flow in the oil and gas space in the last couple of days. And to add to all of it, I mean, a lot of these oil and gas companies are obviously big importers. They import either crude oil or they import gas, and we're dealing with the rupee at 90 now. So let's discuss the dynamics of the sector with Probal Sen, who tracks the space very, very closely at ICICI Securities. Probal, thanks for joining in. I know we just discussed GRMs a couple of days back, but then there's so many moving parts. Yesterday there was a report indicating that Henry Hub prices have gone up quite significantly. And some of the brokers indicated that this could, be maybe a bit negative for IGL and MGL. Now, the stocks didn't fall at least yesterday. But how do you interpret this whole event? And then throw in the currency angle as well. What should we be in for? So let's start with the gas companies, the importers, and the downstream distributors, that is the city gas distribution players.
So just the first question, which is the Henry Hub strengthening. Obviously, what has happened over the last 6 months is that a lot of these CGDs have actually moved away from buying LNG on spot rates or even term rates and have actually resorted to buying it on linkages to Henry Hub. So obviously, given that Henry Hub prices have started to move up, that means that the cost of gas would start to get expensive, at least on the tranches that they have tied up. To their credit, however, what has been seen, at least over the last 6 to 9 months, is nobody is really tying up, the entirety of their volumes in extremely long-term contracts. There is probably a movement away from contracts which are very long-term to maybe mid-term contracts with a little bit of flexibility built in. So what really happens, I think, is that there is obviously a take or pay percentage that is inbuilt into a lot of these gas contracts, which could be 80% or which could be 90%. That depends, frankly, from contract to contract. So to the extent that you can restrict your volumes to the take or pay quantity, you can actually shift to other gas sources which are maybe cheaper at this point of time. And very clearly, what is happening is the US, with the kind of rise in exports that it is seeing, it is obviously seeing its domestic hub prices actually starting to really strengthen quite substantially. And I think that trend will probably continue as more and more with the kind of LNG export capacity that is slated to come online from the US in the next couple of years. That will probably continue. What will happen is you will probably shift your contracts once again, maybe to midterm or even to spot contracts, because there the kind of excess capacity that is likely to come on stream in the next 12 to 18 months will help you reduce the costs. Having said that, to sum up, cash cost will probably rise in the near term to a certain extent, because absolute prices are rising. And as you mentioned, the rupee depreciation, I think, is obviously a major impact. As of now, I think 88 to 89 is something that anyways most companies have been working with. We'll have to see whether there is any other hedge that the companies have taken against the further depreciation that's happened. But as of now, I think directionally, I think margins will continue to remain under pressure for at least the next couple of quarters. I think that's how one has to look at it.
All right. Hi, Probal. Good morning and good to see you, Ben. Reliance Industries has seen a rating upgrade coming in from S&P. How does this change things? Are you tweaking things a little bit? If you could tell us in terms of, how will this affect some estimates, if at all?
No, I think with Reliance, we've always assumed, and that's something that they've demonstrated, that their rating is always close to, if not better than, the sovereign. And that reflects in the kind of competitive gas cost, rates that they are able to negotiate from the market. And I think that is something, this new rating upgrade is something that's a reaffirmation of that. I think their cost of capital continues to remain the most competitive amongst any large cap companies in the country. And I think that is something that will probably continue. What is I think going to be interesting is the kind of downstream margin strength, and we spoke about this earlier as well, the kind of downstream margin strength that we have seen, particularly in the refining space. How does it actually reflect in their OTC earnings, in the third quarter earnings? I think that is something that will be interesting to watch. Our sense is that sequentially they should actually see quite a bit of growth coming through in the OTC segment, which would help, offset the I beg your pardon, which will help offset the damage of the depreciating rupee to a certain extent. But this rating upgrade, I think, is not really something that will change anything as such. We anyways build in fairly competitive cost of capital for Reliance on all of their debt.
Probably lastly, ONGC and Petronet signed this big long-term deal, right? 15-year deal. ethane loading, unloading. Now, I don't know if this is just logistics or if this really plays into something more significant for the P&L accounts of either of these two companies. Your thoughts?
No, I think Petronet LNG has stated before in terms of communication, and I think this is essentially again confirming what they have said, that they are setting up the new lines, the new expansion that is happening at their terminal is the first of its kind, where it will have handling of ethane, propane, as well as LNG all at the same jetty. And they had always stated that one of the monetization strategies in terms of as part of their petrochemical expansion would also be that they would be able to supply ethane to relevant players within their territory in and around. And Opal has a requirement for ethane. It has a dual fuel feed capacity for its petrochemical plant, where it's slated to use ethane as well as naphtha. So this is something that is something that has been guided to for a fairly long time. The signing of the contract obviously creates comfort as far as execution is concerned, that they have revenue visibility on one part of the expansion that they're doing. So in that sense, it's definitely a positive that the what they have basically stated in terms of how they will be able to monetize the large investments they are doing in downstream chemicals. That's something that is actually playing out. And even for Opal, in a way, it's actually a positive because ethane will be at slightly lower cost than naphtha. Sorry, go ahead.
Yeah. No. Point taken, Probal. Thanks for explaining that. Appreciate it, as always, here on CNBC TV 18. Thank you. Thank you for your time. Have a good weekend.